Hi, I am Marcus. Yesterday was one of the most important days in markets this year. A Fed meeting, four Magnificent Seven earnings reports, and an oil crisis update all on the same day. I'm going to break down every single thing that happened. Let us start with the headline. The Dow fell 280 points, its fifth consecutive losing day. The S&P 500 and Nasdaq ended almost exactly flat. But those numbers hide a much bigger story happening underneath. The Dow fell hard because it is loaded with old economy stocks sensitive to oil prices. The Nasdaq barely moved because the AI earnings reports had not yet come in. By the time the market closed at 4 p.m., the real drama was just beginning, after hours. Three massive events collided on the same day. The Federal Reserve announced its rate decision at 2 p.m. Then four Magnificent Seven companies reported earnings after the bell. I'm going to walk you through each one, starting with the Fed. The Federal Reserve held interest rates steady at 3.5 to 3.75%. Markets had priced in a 100% probability of no change. So the decision itself was not the story. The story was the vote. 8 Fed officials voted to hold rates. 4 dissented. That is the most divided Federal Reserve vote since October 1992. The last time 4 FOMC members dissented was over 30 years ago. Something significant is happening inside the Fed. Here is the twist. The 4 dissenters were not all on the same side. 3 of the 4, Hammock, Kashkari, and Logan, wanted to remove the language suggesting future rate cuts are coming. They think inflation is too high to signal easing. The 4th dissenter actually wanted to cut rates immediately. The Fed is pulling in opposite directions. The Fed's official statement contained a sentence that should have gotten more attention. They wrote that inflation is elevated, and they specifically named global energy prices as a factor. That is the Fed officially connecting oil and inflation in writing. It matters enormously for where rates go next. Markets responded by removing all expectations for rate cuts this year. The CME FedWatch tool, and which tracks what traders are betting, now shows zero probability of any cut in 2026. The earliest expected cut is late 2027. That is a major repricing from where we were even 3 months ago. Yesterday was Jerome Powell's final press conference as Federal Reserve Chair. His term ends May 15th. For 8 years, he navigated the pandemic, historic inflation, a banking crisis, and relentless political pressure. By any measure, that is one of the most turbulent Fed tenures in modern history. But here's the surprise. Powell announced he is not leaving the Fed entirely. He will remain on the Board of Governors, an indefinite stay. The reason? An ongoing legal dispute with the Trump administration over his removal. He told reporters, and I am paraphrasing, that he has had to resort to the courts to protect his position, and has been successful so far. This would mark the first time since Mariner Eccles in 1948 that a sitting Fed chair did not leave the board after their term. Eccles was also kept in place by a White House clash over monetary independence. History is rhyming very loudly right now. Kevin Warsh, Trump's nominee to replace Powell, passed through the Senate Banking Committee on Wednesday. Warsh was Ben Bernanke's right hand during the 2008 financial crisis. Markets see him as a source of stability. His full Senate confirmation vote is expected soon before the May 15th transition. After the Fed closed its press conference, Wall Street pivoted to the most important earnings night of the year. 4 Magnificent Seven companies, Microsoft, Alphabet, Amazon, and Meta, all reported on the same evening. The question everyone needed answered: is AI generating real revenue or just real spending? Microsoft delivered first. Azure cloud revenue grew 40% year over year, beating both expectations and their own guidance. That is not the kind of number you see from a company where AI investment is failing. Microsoft also raised its full-year capital spending outlook. The market read this as a clear win. Microsoft shares edged higher after hours. Then Alphabet arrived, and it was a blowout. Google Cloud grew 63%. That is not a typo. The previous quarter was 48% growth. It accelerated. Total revenue hit $109.9 billion, beating estimates by nearly $3 billion. earnings per share of 5.11, nearly double what analysts expected. Alphabet surged 6% after hours. Amazon also beat. AWS cloud revenue continued growing strongly, and Amazon's overall quarter came in above estimates. The stock rose 4% after hours. For 2 days running, the narrative had been that AI spending might not be paying off. Amazon's numbers directly challenged that story. And then Meta, the complicated one. Meta beat on revenue. They beat on user growth, but their capital expenditure guidance for the full year came in at $135 billion. At the midpoint. That is an enormous number. Investors who wanted proof that AI spending is controlled did not get it. Meta fell 7% after hours. So the verdict, 3 of 4 beat meaningfully and rewarded investors. 1. Meta raised questions about spending discipline. On balance, the earnings night answered the OpenAI concern from Script 1. AI is generating real revenue. Google Cloud at 63% growth is impossible to dismiss. I want to spend a moment on Alphabet because the numbers inside their report are genuinely historic. Google Cloud's backlog, the contracts already signed but not yet recognized as revenue, nearly doubled in a single quarter to over $460 billion. That means future revenue is locked in at a scale the market has never seen. And the CEO, Sundar Pichai, said something that no tech executive has said before in an earnings call. He stated that enterprise AI solutions became the primary growth driver for Google Cloud for the first time in a single quarter. That is the moment AI shifted from a cost center to a revenue engine. For context, Google Cloud grew 63%, Azure grew 40%, AWS grew 24%. All 3 of the major cloud platforms are accelerating simultaneously. That tells you enterprise AI adoption is real and broad, not a single company story. Now let me explain why Meta fell despite beating earnings. $135 billion in capital expenditure for this year alone is the largest single company AI spending commitment in history. Investors are asking a simple question. When does that spending generate proportional returns? The bull case for Meta is that this spending builds an AI infrastructure moat that competitors cannot match. The bear case is that $135 billion with no clear timeline to proportional returns is a risk the market cannot ignore. Both arguments have merit, and the stock price reflects that tension. While markets were watching earnings, the oil situation escalated further. West Texas Intermediate crude traded above $107 a barrel overnight. Brent crude, the international benchmark, hit 119. And the reason is a major diplomatic development. The Axios news agency reported that President Trump rejected Iran's proposal to reopen the Strait of Hormuz. Then the Wall Street Journal added that Trump has told aides to prepare for an extended blockade of Iranian ports. These are not market rumors. They are official U.S. government positions reported by credible sources. And there is a second oil story that barely made headlines. The United Arab Emirates announced it is exiting OPEC on May 1st. That is one of the most consequential OPEC developments in years. The UAE is a massive producer, and its exit undermines OPEC's ability to coordinate production cuts. Less coordination could mean more supply volatility. Let me connect the oil story to everything else. Oil above $107 means higher fuel costs for every business that ships or manufactures anything. Higher fuel costs push consumer prices up. Higher consumer prices keep inflation above the Fed's 2% target. And inflation above target means the Fed cannot cut rates. That chain is why oil matters so much to stock investors. Beyond the Magnificent Seven, several other important things moved the market yesterday. Seagate Technology surged 17% after a massive earnings beat. NXP Semiconductors, a chip company most retail investors ignore, jumped 25% on strong guidance. And Robinhood fell over 10% after missing earnings expectations. One number that every investor should track, and most do not, is the 10-year Treasury yield. It jumped after the Fed announcement, touching 4.41%. When Treasury yields rise, it means investors are demanding more return for lending money to the U.S. government. because they expect higher inflation or tighter rates for longer. Here's why that matters for your stocks. When Treasury yields rise, bonds become more attractive compared to equities. Growth stocks, particularly AI companies, are valued on future earnings. At higher yields, those future earnings are worth less today. That is the mathematical reason why a Fed rate hold, combined with rising yields, creates headwinds specifically for tech and AI stocks. Today, April 30th, Apple reports earnings after the bell. This will be Tim Cook's final earnings call as CEO. Apple recently announced that John Ternus, the current head of hardware engineering, will become CEO on September 1st. Cook transitions to executive chairman. Why does an Apple CEO transition matter to stock market investors? Because CEO changes at trillion-dollar companies create uncertainty. Markets will want to know how Apple's AI strategy evolves under new leadership, especially as rivals are pouring hundreds of billions into AI infrastructure that Apple has notably not matched. When Apple reports tonight, the three numbers to watch are iPhone demand in China, where competition from Huawei has intensified. Services revenue, which is Apple's highest margin business. And any commentary on Apple Intelligence, their AI suite, because investors want to know if Apple's more conservative AI approach is costing them growth. Let me now step back and answer the question that has been hanging over markets since the OpenAI report triggered Monday's sell-off. Is AI generating real revenue, or is it just generating real spending? After yesterday's earnings reports, we have the clearest answer yet. The evidence says yes. AI is generating real enterprise revenue, and at an accelerating pace. Google Cloud at 63% growth does not happen on hype alone. That growth comes from companies actually paying Google for AI services every month in contracts that are now stacking up in a $460 billion backlog. That is real. The nuance is this. AI revenue is real, but so is AI spending. Google plans to spend $180 to $190 billion this year in capital expenditure. Microsoft raised its spending guidance. Meta committed $135 billion. These companies are betting enormous sums that AI revenue will continue accelerating. So far, the evidence supports that bet. There is a word that economists have been nervous to say out loud: stagflation. It means high inflation combined with slow economic growth. It is what happened in the 1970s, and it is the scenario that every central bank fears most, because rate hikes fix inflation but hurt growth, creating a policy trap. Right now, three conditions for stagflation are present simultaneously. Oil above $107 is pushing inflation higher. Moody's recession model sits at 49%, suggesting growth is slowing, and the Federal Reserve is frozen, unable to cut rates because inflation is too high, unable to raise them without crushing growth. I want to be clear about this. We are not in stagflation yet. GDP is still growing. Consumer spending, as we saw from Starbucks, Coca-Cola, and General Motors, remains healthy. But the stagflation risk is elevated enough that it belongs in every investor's thinking right now. JP Morgan's trading desk wrote to clients yesterday that Magnificent Seven earnings should be a positive catalyst. But that positioning suggests an increasing probability of a near-term top forming before the bull run resumes. Translation: the good earnings are already expected. The surprises beyond expectations are what move prices. The smart money rotation we are watching is out of AI infrastructure plays and into two places: energy companies benefiting from high oil, and defensive sectors like consumer staples and healthcare that are less sensitive to rate and inflation movements. This is not panic, it is professional capital management. But here's the part of yesterday that I think the financial media is completely missing. And this changes how you should read the entire week. On the Alphabet earnings call, Sundar Pichai said something extraordinary. He told analysts, I'm quoting directly, "Our cloud revenue would have been higher if we were able to meet the demand." The constraint on AI revenue right now is not lack of demand. It is lack of supply. Companies want more AI than the cloud providers can currently deliver. Think about what that means for the entire investment thesis. If AI demand is outrunning supply, then the massive capital expenditure being spent by Google Microsoft, and Amazon is not reckless. It is a response to demand they literally cannot satisfy with current infrastructure. The CapEx is not a risk. It is a race to meet real customer demand. Here's your action plan for the rest of this week. 4 things to watch. First, Apple earnings tonight. Second, any update on Strait of Hormuz negotiations or military developments. Third, whether oil holds above or breaks below $107, which is now the key inflation signal. Fourth, Fed meeting minutes, which will reveal how divided the thinking truly is. And here's the reframe I want to leave you with. The question is no longer whether AI will succeed. Yesterday's cloud numbers, 63% at Google, 40% at Azure, settled that. The question now is which companies capture AI revenue versus which companies only fund the infrastructure. Those are 2 very different investments. I am Marcus. Drop a comment. What was your biggest takeaway from yesterday? Google's blowout, the Fed drama, or the oil escalation? Subscribe for daily market breakdowns. Apple reports tonight. I will be back tomorrow with the full analysis. I will see you then.